Welcome to the module on Foreign Exchange Market 1. So in tune with the globalization policy, it is said that the foreign exchange basically deals with the volume of transactions that are done across the globe in between the countries. And this is very much apt with the adoption of an outward-oriented policy which aims for export promotion. So in this particular context, the demand for foreign exchange and the supply of foreign exchange are related with each other. This boils down to the concept of currency market. So by currency market, we mean where the money is denominated in one currency can be bought and sold with the money denominated in another currency. That is where the currency can be convertible to each other. This is basically adopted in the policy framework of any nation. For example, in Indian economy, there was adoption of partial convertibility in the year 1991, and later on there was full convertibility of rupee, where mean it can be done in both the current account and the capital account of foreign exchange. So this also brings the clear idea about how the currencies can be convertible so as to initiate the international business and make it convenient for the foreign investors. This also boils down to the concept of international trade and capital transactions. Whenever we are discussing about the foreign exchange, it is basically the fallout of the trade. And here trade refers to the exchange of goods and services. So with the adoption of international trade, which is also dealing with the adoption of capital transactions, where the flows of the capital are considered, for example, foreign direct investment, portfolio investment, and other capital flows, it is very much important to facilitate the ability of purchasing power between the countries. Because a country may be poor in terms of per capita income, but after trading, the country's wealth or the country's financial condition may improve. So actually trade facilitates the countries to develop a more important strength and also to get the betterment of international trade. This also refers to the gains from trade. So whenever we are discussing about any purchasing power issues across the countries, it is the exchange rate which is normalized or adjusted with the purchasing power, and thereby the trade facilitation can take place. Now we move on to the concept of the important areas where we can go for this foreign exchange. That means what can be the institutional logistics necessary for the foreign exchange players to cooperate or to operate. First and foremost, with reference to the specific location, it is said that there is no specific location. That means for international trade or the foreign exchange to deliver, it cannot be done in a manual basis. So there should be a digital platform or a digital portal which will facilitate this trade. Secondly, it can be done by the SWIFT mode, which is Society for Worldwide Interbank Financial Telecommunications. So with the help of the SWIFT code, the money or the transactions can be done through a digital platform, and thereby the countries can benefit from the conversions from one exchange rate to the other. So this is very much inevitable within a robust foreign exchange market where the currency exchange and the convertibility can be done for the betterment of the exporters as well as the importers. Moreover, it is being said that with reference to the participants in the foreign exchange market who will get the maximum advantage of this kind of modes. So it is said that in case of SWIFT mode or in case of international trade, where the demand for foreign exchange and the supply of foreign exchange are dealt together, who are the participatory agents or who are the participatory bodies. So the participants in the foreign exchange is being done at two levels. Firstly, it is done by the wholesale, which is comprising of 95% of the total transactions, that is being regulated by the major banks. So across the globe, there are certain commercial banks, and also the apex bank of a nation takes care of the dealing with the foreign exchange at the centralized level. And then we have the retail level, which takes care in case of the multiple outlets or the franchises which has come up. So all these are regulated under the supervision of Export Credit Guarantee Corporation in India, which looks after the flow of the foreign exchange, how the wholesale level is being done, and how the retail outlets are maintained. So the participation of the foreign exchange market is considered to be robust in the sense that how we can take care of the major players in the market and how they can interact with each other. This also boils down to the business customers. because it is said with the development of the capital market across the franchises or apart from the franchises, it is the business customers which are being addressed. This is because of widening the export base and also explaining the international players as they come up. So this also takes care of the participatory level in the foreign exchange market. Moreover, when we look at the participants in the foreign exchange market, we can invite a question in this ground that who are the participants in this market? The major participants refer to the banks, who are the apex bodies and who take up this dealing of the foreign exchange in a more convenient manner. And secondly, at the retail level, we have the business customers, because these business customers take up the issues in a more professional mode with the help of a robust capital market and whereby the transactions are monitored or supervised. This boils down to the concept of organization of the foreign exchange market. So after the discussions of the concept of participatory bodies or the players along with the currency concept, now we move on to how the foreign exchange market is organized, or what are the pillars of the organization of this market. So in the context of organization, we are going to discuss on two types of currency markets. The first one is the spot market, and later on we shall be discussing about the forward market. So when we look at the spot market, as it is being said that it is an immediate transaction. So it is being done on a day-to-day basis, whereby the foreign exchange value is being recorded, and on the basis of that the transactions or any kind of business activities are taken place. And sometimes it is also recorded by the second business day. So this also refers to the spot market where the second business day comes in. So spot market is one of the essential element of the currency market which calls for immediate transaction, and also the recordings are being done so that the transaction can be done by the second business day. Next we have on the concept of the forward market. So when we refer to the forward market, it is being done at a specified future date. This is important because in case of long-term transactions between a country or across the countries, it is necessary to develop an international competitiveness, necessary to build on the customers or the investors' confidence so that the transactions can take place at a future date. This also is very much important whenever the transactions are taken up by the country in a holistic manner, particularly when the diversification takes place across different sectors. So in such case, forward rate is always preferred to the spot rate because forward rate adjusts itself with the economic fluctuations or the economic shocks. So as a matter of fact, since it is realized, since the earnings or the transactions are realized at a future date, forward market is considered to take care of all the shocks or absorbs all the elements in it. This also boils down to the participants in the market, as we can see. So firstly, with regard to the spot market, where the evaluation is being done at the current date and the time, the major participant are the commercial banks, which have the foreign exchange division and where the currency convertibility takes place, and it is monitored by the central bank of the country. Then we have the brokers, because these brokers act as the agents who are basically determining the volume of foreign exchange based on the rate which is decided. And then we have the customers of the commercial and the central banks. This is also very much important with regard to the spot market, that how the commercial and the central banks are basically being linked up with the help of the spot market issues. After this, we have the discussions of the forward market. So among the forward market, we have the concepts of arbitrages, traders, hedgers, and speculators. So whenever we talk about the arbitrage, it is one of the most important and crucial component in any financial market or matter dealing with international finance. They are basically buying at a lower price and selling at a higher price, and that is how the arbitrages are making profit out of the dealings in the foreign exchange. And this can be done whenever the foreign exchange rate is floating or flexible. If we look at the traders, they are basically the business customers who are meant, which also comprises of the brokers in it. The hedgers always look for the future date realization, where the exchanges are to be futurized or futurely it has to be evaluated, in this case. And finally comes the speculators, who are actually depending upon the movements of the economy in terms of major variables like inflation, stability variables, and also some of the growth momentum that the economy goes through. So based on these four agents, who wants to realize them in the forward market, the most strong and the committed ones are the arbitrageurs, and thereby comes the traders, hedgers, and the speculators, who are the major participants in the forward market. So this boils down to the question regarding what are spot and forward markets. The spot market is that when the realization is done on a specific date and the time, and the forward market is basically being done which is being realized at a future date and which comprises of major participants like arbitrageurs, hedgers, and speculators and others. This boils down to more discussions on organization of the foreign exchange market, for example in terms of the logistics infrastructure that is being created. So this refers to the clearing systems. So among the clearing systems, the first one which has come up in the US economy for a longer period of time, or in majority of the advanced economies, is for electronic fund transfers called the CHIPS, which stands for Clearing House Interbank Payment System. So this is basically being done in order to raise any kind of debts or any kind of capital across the banks, and how this capital is being realized and electronic fund transfers are being done. So this clearing system is used in the US market, and thereby the dollars can be exchanged in terms of other currency, and such the system can become more inevitable. Next system that we want to work on is basically the Fedware. Now the Fedware is used for domestic transfers. Here Fed refers to Federal Reserve, which is operated by the Federal Reserve Bank, and it will be used for the domestic transfers, particularly within the nation, and also it will take care of the currency fluctuations. So it is adjusted to mitigate some of the currency volatilities as far as the transactions are concerned. Then we have the discussions on electronic trading. So when we refer to electronic trading, the most important organizational issue is after the participants are being identified, after the clearing systems are being recognized, the next component that comes in is how the trading can be done. So there are various platforms which has come up for the better or the efficient provisioning of electronic trading. One of them is automated trading system. This refers to the genuine screen-based market. That means a kind of a digital display regarding the movements of the foreign exchange across the globe, and thereby capturing the major falls or the major rises or the upsurges in the value of the foreign exchange and taking the corrective actions. So a screen-based genuine market trading will make the automated trading to be more and more flexible and more convenient for the participators, mainly the participants of the foreign exchange market in terms of ECGC players, and that refers to automated trading. When we are going for some of the other trading platforms, so we can invite a question in this regard that name the trading platforms, because this is the minimum logistic infrastructure needed to make the foreign exchange to be in play. So among them, the first one is clearing house, the second one is Fedware, and the third one is electronic trading. So these are the three trading platforms which can facilitate the trading activities as it is said. Next we open up for the discussions in details on the spot market, because the spot market is considered within the nature or the mechanism of how the trading will take place. So when we are referring to the spot market, the first one issue that arises is spot quotations. So these are basically being done from a tender base across the major newspapers, and also the major currencies are there for different quotes, because the major currencies in the world comprising of the dollars, euros, yen, and other currencies that are there across the globe, what are the different quotations they come up, which is based on the current price or the today's price, which they are referring as the spot price. Then you have a 30-day within which the realization has to be done for the 30 days, and then otherwise there is a 90-day. That means this kind of fixation of the price can be done in a month, or it can be done within 3 months as far as the realization of the proceeds are concerned. So basically for the spot quotations, it will be published in the leading newspapers, then the different quotes will come up either at the spot price or either within a month or for the 3 months, and thereby the quotations comes in. And in maximum it can take up to 180 days. So whenever we are referring to the spot market, we are going to deal in two ways. First for the bank customers and next for the non-bank customers, whereby we go for a direct quote. Direct quote means we are going to refer to the exchange rate which is being followed. So that is being giving the home currency price of 1 unit of the foreign currency. So how 1 unit of foreign currency can be expressed in terms of the home currency, and that is how the direct quote can be coming up. So that direct quote is basically referring to the non-bank customers in this regard. This also refers to some of the issues which are there within the functioning of the spot market. Among them, the first one is the transaction cost. What is that? Transaction cost is basically taking care of a margin or a spread which is being used to calculate the fee charged by the bank. Because any commercial bank will be involved in these transactions, so it is also the interest of the bank to generate a revenue or the income from this foreign exchange transaction. And that is what they are saying, the bid-ask spread, which is the price at which the bank is willing to buy and the price at which the bank will sell the currency. So the buying price of the currency and the selling price of the currency, this will make a difference or a deviation, and this deviation will be referred as the bid-ask spread, which is one of the most important criteria for the transaction cost in the spot market. So we are referring to this formula where we say that the spread which is being considered as ask minus bid by ask into 100. So that means when we refer to the previous slide, we are saying that ask is the price it will sell. So it is basically the selling price minus the cost price divided by the selling price into 100, and this will be calculated in percentage, which will be actually highlighting the extent of the deviation of the spot market. So this is basically a percent spread formula which says ask minus bid divided by ask into 100. So thereby we move on to the discussions on the other possibilities that can arise in the spot market. The second possibility that comes up after the spread is being decided is a currency arbitrage. So what we mean by that? It means that whenever we are referring to a cross-country dealings or cross-border dealings, the currency rates are bound to differ. So it is being different from the cross rates from one financial center to other. So this refers to the business operations in one country to that of the other, where the cross rates will be differing and the profit opportunities will be existing. So when we mean by the profit opportunities, it means that the profit of one return is more than that of the other, and thereby all the currencies will flow in that country at the cost of the other. So the cross rates differ from one financial center to other, and that is how they can take the advantage of it, which comes under currency arbitrage. So in the same manner, we can see that whenever we are referring to the currency arbitrage, it basically refers to some kind of issues or some kind of caution can be done. Firstly, there will be a kind of a middleman or the traders who will try to reap the profits of this discrimination. So what they will do? They will buy cheap in one international market and sell at a higher price in another. So this will be very much relevant that they will want to purchase in one international market and sell at a higher price in the other. That means they want to reap the profits in between. And secondly, there is a role of available information. So when we talk about available information, it means that available information must be uniform across them. Next, we move on to the settlement date value, which can also be done in terms of second working day or the first working day that is being decided. So this comes up as the after the date of the original transactions as it is being done. And then we have the exchange risk. This is one of the words of caution which can be there in the spot market. So when I say exchange risk, it means the bankers or the middlemen who are involved in it. So first risk is incurring the risk of adverse exchange rate moves. As it is said, the movement of the exchange rate is regulated by the random factors which cannot be predicted. So any kind of resilience towards this movement must be built on. And secondly, uncertainty about the future exchange rate. That is also very important. By any kind of uncertainty that is there, how it can be accommodated in it. So uncertainty is also one of the most important factor in case of the spot market. So in case of the spot market, we can invite a question on explain the spot market and also identify the risk in this regard, like the exchange risk as it is being said. After the spot market, we move on to the forward market. So forward market has a futuristic vision which says an agreement between a bank and a customer to deliver a specified amount of currency against the future currency at a future date and a fixed exchange rate. So when I talk about the forward contract, at a future rate it is being decided and it will be disclosed. This also boils down to the purpose of the forward rate, which is basically act of reducing the exchange rate risk. Because whenever we go for any risk management, it is always convenient to take the risk for future. And also we go for the forward rate quotations, which can be done to the commercial customers or which can be done through bank. If it is done to the commercial customers, it is done outright rate. Otherwise, whenever the bank intervenes, then we have the interbank banking rate or the swap rate. So these two are important, outright and swap. And on the basis of that, we can see how the calculation of this premium rate is being done, which is done in two ways. One, F minus S, that is forward minus spot, because of making it more and more rationalized or getting it streamlined, divided by the spot rate into 12 by n into 100. So 12 is the total number of months that is being done, and that is how it is being considered. So a forward rate always gives an idea that an agreement is being done between the bank and a customer to deliver as a specified amount of currency against another currency, either at a future rate or at a fixed rate. So in this particular module, we are basically discussing about the concept of foreign exchange market, also explaining the concept of spot and the forward rates, how they work, where the spot rate is subject to more risk, but for forward rate, the mitigation of the risk can be done, and the clearing mechanisms, how they function, along with a logistical infrastructure, for example, the digital platforms. And then only we can say that the foreign exchange market can perform and can actually meet the needs of the exporters and the importers.